The agreement you never voted for. What if the most powerful deal in modern history was never announced, never debated, and never voted on? What if it wasn't signed in secret chambers under candlelight but passed quietly through laws, reforms, and temporary emergency measures? And what if that deal handed more power to banks than to governments themselves? Most people believe governments control banks, that central banks answer to elected officials, that when crises hit, leaders step in and restore order. But history tells a more complicated story. Because over the last century, during wars, depressions, and financial collapses, something subtle happened. A quiet exchange. Governments gained immediate relief. Banks gained long-term control. This is the story of the silent deal that handed banks global power. And once you see the pattern, you can't unsee it. Setting the stage. Before the deal, to understand how this happened, we have to go back to a time when money was tangible. Before 1914, most major economies operated under the gold standard. Currency wasn't just paper, it represented a claim on gold. Governments couldn't simply print endless money. Every note had a limit anchored to a scarce asset. This constraint created stability, but it also limited flexibility. Governments couldn't easily fund wars or massive spending without raising taxes or borrowing heavily. Then World War erupted. Governments faced an impossible choice: either tax citizens heavily during wartime, or borrow. They chose to borrow. And who could provide large-scale loans quickly? Banks. For the first time, governments leaned heavily on central banking systems to finance massive war expenditures. Gold convertibility was suspended in many countries. Paper promises replaced metal certainty. This was the first crack. But it didn't look like a power shift. It looked like necessity. After the war, instead of returning fully to gold discipline, nations experimented with hybrid systems: partial gold backing, expanding central bank authority, and greater reliance on debt markets. The seeds were planted. Origins: the birth of modern central banking power in 1913. Just before the war, the United States created the Federal Reserve System. Marketed as a stabilizing force to prevent financial panics, it centralized monetary power in a way never seen before. On paper, it was a solution. In practice, it created something new: a partnership between government and the banking institutions. The government gained a buyer for its debt. The central bank gained the authority to expand money supply and influence interest rates. But here's where the silent deal begins to take shape. Whenever governments overspent, central banks could purchase government bonds, injecting money into the system. This reduced political pressure to balance budgets. Borrowing became easier than discipline. Debt slowly transformed from emergency tool into permanent strategy. The Great Depression accelerated this shift. Massive economic collapse led to expanded central bank intervention. The gold standard weakened further. In 1933, the United States suspended domestic gold convertibility entirely. The restraint was loosening. Rise. When money stopped being real, the true turning point came in 1971. For decades after World War II, under the Bretton Woods system, global currencies were tied to the U.S. dollar, and the dollar was tied to gold. But the United States had been running persistent deficits, funding wars and social programs with borrowed money. Foreign nations began redeeming dollars for gold. The gold reserves were shrinking. Then, on August 15, 1971, President Richard Nixon ended the dollar's convertibility to gold. No more gold anchor. No more fixed limit. Money became fiat backed not by metal, but by trust in the government decree. This wasn't framed as a surrender of discipline. It was presented as modernization. But something profound changed. Without gold constraints, central banks could expand the money supply indefinitely. Governments could issue debt without a hard physical ceiling. The silent deal deepened. Governments gained unlimited financing flexibility. Banks gained influence over the cost of money itself. Interest rates set by central banks became the steering wheel of the global economy. Housing markets, stock markets, corporate expansion, consumer borrowing all began orbiting around central bank policy. Power had shifted. Breaking point. Crises that consolidate control. If the system were unstable, you'd expect it to collapse. Instead, something different happened. Every major crisis expanded central banking authority. Take 2008, A housing bubble fueled by easy credit and low interest rates imploded. Major financial institutions teetered on collapse. The public expected consequences. Instead, central banks intervened with unprecedented action. Trillions in liquidity injections, quantitative easing, emergency lending facilities, near zero interest rates. The justification was stability. But consider the pattern. Private banks took excessive risks. When the system broke, central banks backed by government stepped in to rescue the financial infrastructure. The public absorbed the long-term cost through inflation and the future debt obligations. After 2008, central bank balance sheets ballooned. Asset purchases became normalized. Markets grew dependent on monetary stimulus. The deal became visible but rarely discussed. When crises hit, central banks don't shrink, they expand. Fallout: our world built on debt today. Global debt exceeds $300 trillion. That includes government debt, corporate debt, and the household debt. Nearly every major country operates with structural deficits. Governments roll over debt rather than repay it. Central banks hold massive portions of sovereign bonds. The system is no more longer temporary emergency policy. It is structural. Low interest rates encourage borrowing. Borrowing fuels growth. Growth sustains markets. Markets rely on central bank signals. The silent deal has matured into a feedback loop. Governments depend on cheap debt. Markets depend on liquidity. Banks depend on backstops. And the citizens depend on wages that struggle to keep pace with asset inflation. Look at housing prices over the last 3 decades. In many countries, home values have risen far faster than median incomes. Why? Because credit expansion makes more money available to chase the same assets. The result isn't just inflation. The more leveraged the system becomes, the harder it is to reverse course.